Making your money work for you is one of the most frequent pieces of financial advice you will hear today. There's a good reason this tired advice is frequently given though, because it is accurate, it is shared. Those who are financially successful are aware that money is a tool that should be used to advance in one's career. Unfortunately, a lot of people believe that you need a lot of cash to begin investing, but that isn't at all the case. And I'll show you how to invest in 2022 on a tight budget by sharing that information with you. But before we get deeper, if you're new to this channel, hit the subscribe button and the notification bell so you don't miss any of our videos. So without further ado, let's get started. I can still clearly recall my very first investment success. It appeared to me as though I had just witnessed magic in action. I invested $1,000 in an oil and gas company when I first started investing, which was a large sum of money for me at that time. I came back to check on my stock holding after patiently waiting a year, during which time, if I'm being completely honest with just myself, I completely forgot I even owned the stock in the first place. I couldn't believe what I saw. My initial $1,000 investment in stocks had grown to $1,100. The fact that I could make money without doing any work, especially as someone who's rather lazy to begin with, blew my mind. From this experience, I learned that investing is a powerful means of building wealth and that it doesn't take a lot of money to get started. The only way to stay ahead of the curve is to invest because the cost of living is increasing at a rate that is significantly higher than what the bank will offer you each year. If you believe that current prices are absurd, be sure to click the like button below because it is the last remaining free form of funding in the world. Not to mention, I think you owe it to yourself to use your money as efficiently as you can. Money is earned through hard work. The very least you can expect from your money is for it to increase your wealth on your behalf. This also means that investing your money is very crucial. But before you even consider investing, you need to take care of a few housekeeping chores. You must first establish what I refer to as your oh shit fund before investing a single penny in assets that will increase your wealth over time. This is the name I've given to an emergency fund because when faced with a bill or expense, we frequently hear ourselves saying, oh shit. Undoubtedly, this is just another way to refer to an emergency fund. But hey, it's nice to switch things up now and then, isn't it? I advise you to set aside this fund for at least 6 months worth of living expenses. To fully benefit from the freedom this fund grants you, you should have a year's worth of expenses on hand. However, 6 months worth of living expenses will do for those who are eager to begin investing. You must make sure you are debt-free once your SHIP fund is established. You must settle any debts you may have before making investments, including any student loans, credit card debt, and even payday loans. How come? Because these debts typically have high interest rates that are difficult to beat when investing. As a result, paying them off will yield a higher return than investing your money in the market. Guess what happens once these two financial obligations are fully taken care of? Start your investments now. I'm going to go over now what I believe are some of the best investment options to look into for those wanting to use the little money they have to start getting ahead. Start with an index fund, which is a relatively straightforward collection of assets. An index fund is a group of investments that enables you to own a small amount of stock in several different businesses. You can diversify your portfolio and receive some degree of protection from bad stock selections by investing in index funds. Say for example, that you invested $1,000 in a business that your uncle wouldn't stop raving about. Your last dinner as a family is now. You believe the company to be promising. But as soon as you purchase stock, the stock plummets because the financial statements were grossly misrepresented. When this occurs, the money you invested could vanish in a matter of seconds. Naturally, we don't want that to occur. Index funds are useful in this situation. Instead of just owning one stock, you could use that initial investment to buy shares of companies like Apple, Microsoft, Amazon, Facebook, Visa, Disney, and many more through a fund like the S&P 500. By doing this, you are distributing your risk among a wide range of different businesses. The other companies that make up the index you invested in can hold on your investment if one company experiences a downturn. People are now trying to persuade you that investing in mutual funds is a better option. A mutual fund is very similar to an index fund, with the exception that it is managed by a professional investor whose responsibility is to select the stocks for the fund. In essence, a mutual fund's goal is to outperform the returns offered by investing in the market as a whole. The vast majority of the time, though, you'd be much better off investing your money in a straightforward index fund with lower fees that typically will also yield higher returns. This explains why index funds have such minimal fees. While mutual funds typically charge higher fees, ranging from 1 to 2% of your account balance annually, most S&P index funds only charge less than 1%. This implies that even if you lost your $10,000 investment in a mutual fund, the fund manager would still receive $200 every year. In contrast, the expense would only be $10 if you had invested the same amount in the S&P 500 index. This is due to the passive management of index funds. There is no need to pay someone who, as I just said, is probably going to perform worse than the computer managing that index fund for you. Even though I adore index funds and believe that they should always comprise a portion of your portfolio as you age, your investing strategy needs to evolve. The older you are, the more bonds I recommend you invest in. And no, even though there are some pretty fantastic James Bond films, I don't mean buying more box sets of the series. You can give your portfolio more stability as you get closer to retirement by increasing your bond investments. Real estate is a different type of investment I like. Real estate appeals to me because it is a tangible asset. But I understand what's going through your mind. Can I afford to own a home with the little money I have? There are essentially only two ways to invest in real estate with a limited budget. Real Estate Investment Trusts, or REITs, are the first option. Similar to mutual funds, these are real estate portfolios that investors can purchase. Investors pool their funds, and as a result, the fund gradually purchases more real estate while you profit along the way. It is typically possible to begin investing in REITs with as little as $500, making it easier than you might think to enter the real estate market. As an alternative, you could start setting aside the little cash you do have to buy a house someday. You can choose what kind of real estate investor you want to be in the interim, though. An investor in capital gains is the first category. This person enjoys making money by buying things at a discount and selling them at a premium. When looking to make a profit, these investors are drawn to purchasing homes at auction or searching for excellent deals in their local areas. Cash flow investors are the second category of real estate investors. If the rent is insufficient to pay the mortgage, these people will never purchase a property. As a result, they adhere to the 1% rule, which states that to increase the likelihood of producing a positive cash flow, the property must generate 1% of its value in rent each month. Now, I'd be remiss if I didn't discuss specific stocks, so let's do that right away. I am frequently asked about individual stocks out of all the available assets, and I can see why this is because they are a very appealing investment option for many people. This is so that you can invest little, earn great returns, and sell whenever you like. In contrast to real estate, where you must find a buyer and complete the entire selling process with a click of a button, single stock investing, which is my preferred investing strategy, gives you full access to your money. Make sure you know what you're investing in if you decide to take this route. I see so many people making stock investments based on recommendations from friends and family, and these bets rarely pay off. Instead, if you're going to invest in individual stocks, take your time and make a wise choice. When I do choose to invest in this way, I value stocks using two different methods: Quantitative analysis is the first type of evaluation I use. You might be surprised to learn that the stock price you find when you Google it isn't the true value of the asset. It's more of a guess. The value might be much higher in many instances. Do you have any idea when this occurs? To get a better sense of the value of a company, I like to look at its quarterly earnings reports, which include items like balance sheet, income, and cash flow statements. Qualitative analysis is the second method of valuation that you can employ. This is more about the ethereal characteristics that define a great company than it is about the actual numbers. A prime illustration of this is Tesla. There is no denying that Tesla's finances do contribute to its rising share price. But the company is much more than the statistics that support it. For instance, it's unusual to find a business run by a visionary like Elon Musk or to have a following as fervent as Tesla. If you're considering investing in a company, you should take into account all of these factors when estimating its future value. Last but not least, if you choose to invest in individual stocks, be sure to build a diverse portfolio. Investing in a single company or industry is a mistake I frequently observe new investors making. You must diversify your business operations. For proper diversification, it is advised that you spread yourself across various industries, such as healthcare, technology, consumer goods, and so on. In this way, you shield yourself from the occurrence, which happens more frequently than you might think, of a business failing or an industry experiencing protracted hard times. Well, there you have it, guys. Thanks for watching. If you're new to this channel, make sure to subscribe and hit the notification bell button to get updated on our latest videos. Don't forget to like this video and drop a comment. See you next time.